Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to unpack your stock-related questions tonight are Rowan Williams from Nitrogen Fund Managers and Drikus Combrinck from Capicraft. Please be sure to send your questions via email to stockwatch@bdtv.co.za or SMS at 41392 or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. I still have to get used to calling Twitter X. Let me start off with you, Drikus. As much as we have seen a rebound in today's market action, there's been a lot of selling. How weak is the market at this point?
Well, I think you have to take a step back and say what's happened the last 3 months before the recent sell-off. The last 3 months, you've had a weaker dollar, interest rates curve declining all over the world, money flowing into emerging markets, into some commodities, like precious metals, and onto our shores as well. And a bit of that trade has reversed the last few days or so. Might be just a correction as part of a larger move. I'm not too sure. Jury's still out. Our portfolios aren't too dependent on that, but I do think that we've seen a top in interest rates for now, and that'll be dollar negative. The dollar has gained a lot of its losses, but somewhere around, if you just look at the 10-year bond in the US, I think that's a good benchmark. Somewhere between 4%. I think yesterday it's closed at about 4.08 and 4.5%. I think is a good fair value for the US 10-year. So closer to 4.5, it can move there. Then you've got a stronger dollar, but weaker emerging markets and elsewhere. And each time it dips below 4%, you'll see a rally in emerging markets. So I think range bound for now.
All right. Rowan, just looking at the rebound that we have seen in the markets today, is this just a dead cat bounce and kind of a volatile environment? And actually, is the cat dead?
Well, yeah, I think what's happened is we've seen quite a big retracement from like a very late December rally. There was a bit of a Santa Claus rally. I think the market got a bit ahead of itself in terms of the timing of an interest rate cut by the Fed. I think we're pretty clear that we have peaked, but the probability of a March cut got sort of over 80% in terms of market forecasts, and that's just being moderated. Even today we saw very strong jobless claims, so that's again, I guess, short-term negative. So I think it's a moderation in terms of expectations. I think the medium term still looks okay, as Drikus said, in terms of, I think there will be a rotation into EM as we do see the Fed starting to cut. We expect only in around June. Today, particularly on the market, Richemont had a very good update. The market took that well. That's actually contributed the bulk of the move today. So it is still very subdued. We are still seeing continued weakness in China. That's weighing on the commodity sector, so quite a mixed bag, but I think a very slow start. But I think for the medium term, the outlook for the JC for the year is still reasonable.
Yeah, and actually, as we're talking about Richemont, I want to come to you, Drikus. They did release their third quarter numbers today. And actually quite interesting how the markets reacted, because I think the last time they churned out numbers, the markets were quite disappointed. Obviously today, it's a completely different story. That share up almost 11%. Your take on those numbers and the market reaction today?
Yeah, so Richemont has had a terrible year last year. Some of that is, let's start with why it did well in 2021 and 22 is, you've got this post-COVID spending boom that obviously just help Richemont and other luxury retailers, etc. But consumers were less willing to spend last year relative to, say, 2022. That came in. China's quite weak. A lot of the earnings power, earnings momentum, earnings growth potential does come from the Chinese economy when it comes to the likes of Richemont. And the Chinese economy is not doing too well at the moment. So I think the market is relieved, actually, to see that Richemont is doing not too badly, all the while other stocks coupled in some way to the Chinese growth story is doing very poorly at the moment.
Rowan, as much as that stock has rebounded today, it had been under pressure, as Drikus mentioned, a lot of last year, and a lot of investors were seeing that as a buying opportunity. At this point, do you still think, even with the rebound today, that it could still provide an opportunity for someone who maybe missed the boat last year?
Yeah, I mean, I think there has been some, as you say, buying, and analysts saying that it is a buy and depressed. So it is an opportunity. I think obviously where you're in it prior to today, you've done quite well. Unfortunately, it adjusts very quickly, up over 10%. The sort of price adjustment is almost immediate. I mean, a 2% sales beat, the share goes up 10%. So in the short term, I think a lot of it sort of, the potential and sort of the lower slowdown or less worse slowdown is sort of now in the price. So you do have to trade it a little bit. I think what you did see in terms of make up those numbers, the US slightly stronger than anticipated, China slightly weaker. If we do as we expect to see the US economy slow down as those rate hikes bite, that demand will still slow down. So I think, as I say, if you didn't get into it before today, probably maybe it's a hold, and you wouldn't rush into it now. It really depends on the trajectory of the US economy from here. December sales were strong. So, yeah, I think either you're going to have a strong US economy, rates high, which is negative, or weaker US economy, rates will come down. But that's also somewhat negative for the Richemont story here.
All right. There was actually a question that I am trying to find, and it was on the JSE's makeup and also sentiment. So it goes, the Dow, S&P and NASDAQ have been flying. If, as Wayne says, the big SA companies have such a high concentration of business outside of South Africa, why do their share prices not respond to foreign sentiment rather than to SA's depressed outlook? Or is it that they do not have much in the way of trading in the USA rather than Europe? Yeah, so the question is basically, there's such a high concentration of these companies that are exposed offshore, but yet the JSE is still victim to, the depressed outlook of South Africa. Drikus, do you have a comment on that?
Yeah, one of the things that most irritates me, one of those misnomers in the markets is the concept of a rand hedge. Just because somebody exports something doesn't mean it does well when things are going poorly here. Firstly, a lot of those companies have assets in SA. So if you're a coal exporter and the coal price might be doing well and the rand might be doing poorly, but if you can't get that to market because Transnet is unable to transport it, then you've got a problem. Okay, so firstly, that one needs to be addressed. But secondly, is our market, to a large extent, if you look at the likes of Richemont, less so than previously, but our commodity producers, Naspers process, obviously, they're proxies. Our market has become a proxy for what our China's doing. So the bulk of our losses last year was all due to, let's say, China-linked or commodity-linked counters on the JSE, while the domestic shares did actually quite well. Your industrials, normal industrials, local companies, retailers not as well. Some of them banks did well. The Findi did well, and one of the best performers was the property sector locally. So those actually that did not stand to benefit from a better offshore environment, those actually did the best on the JSE.
Yeah. Rowan, on your side, I mean, as Drikus says, I mean, as much as you do have these companies that, export outside South Africa, they also still do have assets in South Africa. So at this point, is it no longer a clear question of whether to invest in SA Inc. or to invest in these counters that are exposed to offshore markets?
Yeah, so I completely agree with Drikus. It's become a proxy for China. I mean, we've got Tencent is the major asset within Naspers process. That's Chinese internet. It's not global tech. And so I guess the very short answer to the view is sort of long China and no exposure to US tech. We know that the Magnificent Seven, as they're now called in the US, the S&P and as well as the NASDAQ, we're actually the main drivers of performance there. And you get no exposure to that through the JSE. You get exposure to the Chinese economy. We calculate, yes, that sort of up to 60% of the market cap of the JSE is sort of rand hedge or non-South Africa exposed, but it is a very specific set of assets. And actually, yes, some of the domestic industrials did well. So the ALSI or the JSE is the single entity. You can't really look at it as such. We see it as 4 distinct buckets: Chinese internet, resources, sort of rand hedge, but you've got BTI that sort of hasn't been doing well, smoking as well, and Richemont, and then domestic industrials, the Findi. And the Findi actually has been a relatively bright spot. So I think you have to think about the JSE more granularly than overall when you're doing stock picking and investing.
Yeah, quite an interesting question also, on that. Rowan mentions, of course, the JSE doesn't have exposure to US tech. There's a question here. I really have to ask whether it is better to invest in US stocks versus JSE stocks. And of course, they reference the higher returns that US stocks got versus the JSE. Drikus?
Yeah, well, I've seen a movie quite similar to this one before. Well, same kind of questions. That's back in 2001. Everybody was rushing to get out of the country. The rand had bombed out. Interest rates went to 25%. And just as everybody ran out, they bought into the Nasdaq bubble back then. Just as it was about to burst, it took about 15 years for you to make your money back in rand terms. No, history doesn't repeat, but it does rhyme. There's some lessons to learn there, and not quite the same, the likes of the IT bubble and today. It's not completely the same, but there is a sense of a price for perfection in those magnificent 7, which dominates the market offshore. And I'll be very careful buying in at these levels, and even selling rands to buy dollars at these levels. I'm almost just as concerned about the long-term viability of the dollar than I am about the rand. So we tend to own real assets rather as a hedge in the portfolio, rather than just choose fiat currencies. Fiat currency over the long term is now a hedge at all. They lose value, all of them. They decimate value. The pound has lost 90% of its value over the last 7 or 8 decades since the Second World War. So, and the same with the dollar. If you go long enough back, you just decimate value in fiat currencies. So we own real assets to hedge against, inflation.
Drikus seems to have a little bit of caution there. Rowan, what would you be doing at this point?
Yeah, I actually concur with Drikus. I think what you're seeing is US rates have topped out. And as we do get to a sort of a cutting cycle, which I think will happen sooner or later, maybe the timing is not entirely clear, but it is an opportunity then to rotate. I think that is positive for EM, emerging markets, of which South Africa would squarely fall into. We had a very difficult year for the economy last year, partly because of those bottlenecks, electricity supply, logistics, Transnet, which are slowly easing. We're not getting totally fixed, but less of a drag on the economy. Valuations are actually very depressed. And the JSE does look like pretty good value here. I think growth will improve from very depressed levels. And hence, it does make sense, agree, to rather stick with the JSE if you're already in it. Or if you're thinking of rotating, the dollar, I think, will also weaken. And it has been very strong. The rand may appreciate or not appreciate as badly, and you're probably better off taking a view on South African assets at these levels, at least for the next year. The past year, 2023, is come and gone, so we can only look forward.
All right. Talking about bottlenecks, Transnet challenges, of course, our coal miners being some of the hardest hit there. There's a question on Thungela, which also was not immune to those. The viewer says, I dumped Thungela at 350. Was wondering if there are any prospects of the growth that we did see from about 35 cents per rand per share to 300 per share, if we could see that astronomical growth anytime soon, Drikus.
Well, it depends on the coal price, firstly, and secondly, since the 350, I think they've paid out about 100 rand dividends. So the company's cash flow is much smaller. I think they've got still about 10 or 11 billion rands in cash, but some of that will be used to reinvest in the company. The life of mines inside Tongaat is very short. So even though they're producing a lot of cash flow at the moment, from an EV/EBITDA perspective, the company looks tremendously cheap. You must realize that some of those mines need a lot of reinvestments, or they need to invest elsewhere just to, I think that the general life of mine is about 5 or 6 years at the moment for Tongaat. So a lot of those cash will be reinvested just to maintain, even if they can maintain, just to maintain current production levels.
Yeah, quite
so
a good.
No, it's not going back to 350 unless there's another energy crisis in Europe.
Very interesting there. And, also the viewer bought the share at 32 Rand and dumped it at 350. Quite phenomenal. Rowan, your thoughts on Tongaat? Of course, Drikus says that he doesn't see it getting back to those record levels that we saw. Your thoughts?
Yeah, look, we did look at energy prices. I mean, oils is quite depressed. We have seen US shale production ramp up significantly. So I think the demand supply is better balanced. We do think the global economy is going to slow and cool, which is also negative for energy demand, oil and coal prices. So I would agree that I think that once off sort of bubble was also driven, if you recall, by the Russia-Ukraine conflict, which is ongoing, but that isn't disrupting supply nearly as much. I think there's a lot of cheap Russian oil also continue to seep into global markets. So those all point to sort of moderate energy prices, and as a result, moderate coal prices. So and then I think the transfer challenges remain, which is another headwind for them. So you're probably better off deploying that windfall into other parts of the market.
Yeah, we'll talk about oil. There are two questions on Sasol. The first one, why is the price of Sasol shares dropping? Where do you expect Sasol to bottom out? I actually did see today that it was down about 3%. Drikus, does it have anything to do with the oil price?
Some, but remember, it's a petrochemical company. It's not only an oil producer or a petroleum company. It's a petrochemical company. It's got a chemical division. Chemical prices are quite depressed at the moment, chemical margins. So those aren't doing well. They've got a European plant, and energy situation, obviously, in Europe isn't conducive to that operations. So that'll come in as a big negative when they report again. And I think there's a bit of a leadership problem in Sasol. Fleetwood Grobler is gone. There's no real strategic direction. They've saved the company probably in 2020 by selling a lot of assets at very depressed prices, and that means that they've sold a lot of future cash flow. That's part of the problem. If the company had just focused on its normal coal to liquid plants locally, they would have done much better over the last few years. Much better capital allocators. They've just stuck to their core assets. Maybe the Qatar gas to liquids, those make sense, etc. But elsewhere, the European and American investments have been horrible investments. And then lastly, the problem is the ESG movement has really penalized these guys. There's a lot of ESG issues that they face at the moment. That having an AGM tomorrow and just to keep the provocateurs away, the green guys away from the meeting. They're going completely
virtual,
online, virtual. So I think they've got a lot of issues at the moment, but I do think there's value at this price. It's going to drop further, obviously, but if you wake up tomorrow and there is a bigger war in the Middle East and the oil pops $10-20, Sasol will rally and there will be a lot of shorts covering it.
All right. Well, I mean, Drikus talks about all these challenges, operational challenges, ESG movement. We did also see the disruption at the last AGM last year. Another question on Sasol, how low can Sasol go? It's noted that other companies, for example, BP, Shell and Exxon are also underperforming currently. So is it an opportunity to buy? Rowan?
Yeah, look, it certainly does on paper reflect a lot of value at these levels, but it is quite a complex investment case, money by those ESG concerns and emission concerns. They're also running out of coal stockpiles to feedstock into the Secunda plant, which they don't at the moment really have a long-term solution. Gas is also a problem. So I think these things just make it quite complex, and investors are voting with their feet. I think with the relaxation of the foreign exchange limits for portfolio managers, they're saying we may get exposure to oil and gas elsewhere and pick up one of those US majors that have a much clearer investment case. So we think until there's a change in the sentiment, if that's management or they have a clear plan to address some of those feedstock supply issues, the share's probably going to trend lower in our view. So for us, it's still an avoid, and we would look for some catalyst for a re-rating and a change rather.
All right. Rowan, I want to stick with you because you did mention off air that you can talk a little bit about Ascendis. There's a question here. I have Ascendis share at 83 cents, but they offered to pay 80 cents because of delisting. Should I wait to delist, for the delist to be completed, or sell with the current market price? Rowan?
Yeah, so you can obviously take your 80 cents and then get that in cash and put it into another, say, small cap share. If you decide to stay in, you are going to be a shareholder in an unlisted company. You've got to understand that there will be limited liquidity, not no liquidity, but it's much harder. Obviously, it's got to be a negotiated sale, and you're going to sort of ride on the coattails of the majority shareholders. I think a company like Ascendis in an unlisted environment, without the costs and the distraction, obviously, of being listed, probably can do quite well, and you've got large controlling shareholders that it's in their interest to try drive value. So I think you have to be prepared to stay in for the long term, sort of 5 years plus. Probably not the worst idea if you have that sort of stomach or appetite for illiquid investment of that sort. Otherwise, better rather take the 80 cents and move on.
Earlier on, Drikus, you expressed some caution about getting into the Magnificent Seven at these levels. There's a question here on the NASDAQ 100 ETF. Your view on that, is it a buy? Of course, obviously, the NASDAQ 100 has those stocks, but also other stocks. So would you be staying away because it has those stocks, or would you be seeing it as a buy because of the kind of diversity that it has?
No, I will rather drive a D7 bulldozer through my house than buy the NASDAQ 100 at these levels. As easy as that.
Yeah, all right. And we did obviously get your thoughts earlier on. Rowan, what would you be doing at this point?
Yeah, look, it's I guess it feels contrarian given the momentum, but I would have to agree. I'd rather be looking at cheaper EM stocks. I think what you see is a lot of AI hype in the price levels, and it's all a promise. I mean, I think AI has a lot of potential, but it hasn't really transformed industries significantly. And if you look at the detail, that's probably a 5-year or longer transformation that it becomes sort of adopted into the mainstream. So I think there's disappointment from these levels in terms of the hype, and hence you're getting in at the top. Rather look for good value, emerging market stocks, and I think you're better off in 3 to 5 years.
All right. Well, let's get to your stock picks for today, gents. Drikus, what will it be?
It's Fortress A, FFA on the JSE. Tomorrow there's a vote pending. They're wanting to collapse the current dual listing structure where the FFBs will receive some NEPI rock castles, and the FFBs will disappear basically, and the single structure will be left. There's been a lot of controversy around this one, so I think it's a lot of asset managers are still neglecting this one, but there's a lot of value within Fortress. If you just strip out the value, post the FFB deal, if you strip out the value of NEPI Rockcastle, the remaining assets are trading at a very deep discount, and management has alluded to, rewarding FFA shareholders going forward by doing various transactions, selling some of the portfolio and returning a lot of those cash to the shareholders. They're not a REIT anymore. There's a lot of tax assets inside there, that they can utilize, that they don't need to be a REIT at the moment. And I see them unbundling or returning cash to shareholders or unlocking value in some way over the next few years. So, yeah, FFA.
All right. On your side, Rowan, what will your stock pick be?
We're going with Netcare. So I guess in the theme of sort of looking at South African industrial, Netcare has sort of underperformed post-COVID, struggling to get back to pre-COVID margins. But I think they've done a lot of work in the business in digitizing it and improving efficiencies. Case levels are improving. They've got good positioning in mental health as well, and they're seeing strong demand there. So I think the prospects will improve, margins will improve, maybe not all the way back to pre-COVID levels, but the valuation can move up from here. It's a fairly safe bet. Around 14 Rand, we think, yeah, it's got sort of a reasonable upside over the next 1 or 2 years.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for Stock Watch tonight. Thanks to our guest, Rowan Williams from Nitrogen Fund Managers and Drikus Combrinck from Capicraft.